Steve, Steve Van Houten here, Lifetime Financial Advisors President and Fearless Leader. It's 2024, and I'd like to welcome all of you to our first client webinar for the year. So should you be joining us in this afternoon, this evening, or the morning somewhere, we welcome you. Quick update on the firm. So at this time, celebrating 40 years in this business plus, we're the strongest we've ever been. We grew very handsomely last year. We're now serving 4 generations. That's 4 generations of clients, all the way down to the babies, funding their college in 44 states. And my operations department wanted me to remind everybody that we did 900 client meetings last year. That's 900 face-to-face, telephone calls, travel to, and of course, Zoom. So we've never been more connected, never been more strong. And I've never been more excited about the business and serving our clients and working with this just amazing team that we've assembled. So today is going to be a great day. We have one of our special speakers who was a groundbreaking leader in our presentations over the years. So welcome back, Chris. But before we do that, David's going to share some really great information on our partner, LPL Financial, who is our custodian, who I've been with for over 40 years and have backed us up very nicely. So David, take it away.
All right. Thank you, Steve, and welcome everybody. LPL put out a few stats earlier this year or late last fall, and we want to share that with you. We're really proud to work with LPL. Many of you who've been with us for many years have had your accounts there for a long time. Some of you folks who are newer to us, LPL is probably a newer name, right? And so I'm going to share a little bit of information about LPL, just walk you through. Again, Steve, as he mentioned, has been with LPL and for 40 years. We're really proud of that. So founded in 1989, actually even a little bit earlier than that in a prior capacity. Over 22,000 financial professionals associated with LPL now, and a Fortune 500 company. So they're really big, the #1 independent broker dealer in the country. They've got fantastic platforms and services for us as your advisors and for you as the end investors and our clients. So we're really proud of the growth. We've been with them for a long time. They're #1. And our firm is actually one of the top 1% firms at LPL. So the 22,000 plus advisors, we're in the top 1% of them there. A couple more things just to mention, serving over 7.9 million client accounts, over $1 trillion in assets now, a portion of which, good portion I'm sure, is with Rowe Price. And we're glad to have them on the call today. And a couple more things, they have a huge budget that they're putting into cybersecurity. I know I've had conversations with clients about this recently. They're continuing to invest in technology in a big way. And I think more so than some of their competitors and peers out there. So that's important to LPL, it's important to us. And we just appreciate you being on the journey with us, with Lifetime Financial, with LPL. And with that, I'm excited to have you all on the call today. I'm going to turn it over to Luke, who will introduce our speakers.
Awesome. David, thank you so much. And as David, on behalf of us and the entire team here at Lifetime, we're thrilled to turn the calendar into a new year here in 2024. It's been quite the past couple of years. A record difficult year in 2022, very comparable to financial crisis in terms of the way stocks and bonds performed. We've weathered through that storm, experienced some recovery last year. So now, where do we find ourselves? What can we expect? How do we position portfolios? These are a lot of conversations that we're having here at the office, within our portfolio strategy meetings with you all. So I think it's very timely that we have our great partners in Rowe Price. So a special shout out to Katrina. Thank you so much for bringing the likes of Chris and your great firm's top resources to not only us, but making them available to our clients as well. So certainly excited for today. We'll have a structured presentation, and then Chris has kindly opted to allow us for a little bit of an extended Q&A for those who are joining us live. So Katrina is a regional investment consultant who has been with T. Rowe dating back to 2016. So coming up on her 10-year anniversary there. Been in the financial services industry for more than 15 years, and truly proud to call you a great partner and friend of our entire team here at Lifetime. Thank you for all that you do in support of our clients. Really do appreciate you. And Chris, thank you so much for joining us. This is the second time we've had you on, and as Steve pointed out, some of our best attendance, best participation has come, and that's no mistake, that's no secret. So really, thank you for joining us while on the road. Katrina, I'll let you introduce Chris and get us underway here. Thanks to everybody.
Great. Thank you so much. Hopefully everybody can hear me okay. So thank you for the introduction. Thank you for the partnership. So LPL is obviously a top partner for T. Rowe Price, but your team at Lifetime Financial, I will say, are my favorite to work with. And not just because you're just so personable and genuinely caring toward me, but you can see that reflected with what you do for your clients day in and day out. So caring for them, caring for all those generations, but also just the due diligence you put into what you do utilize, who you do partner with, and then putting people like Chris in front of your clients to share some insights. So for those of you who might not be as familiar with T. Rowe Price, we manage about 1.4 trillion in assets and have been around since 1937. So we have hundreds of, well, really thousands of financial professionals, but we've got over 800 that really work in terms of finding insights that can be shared and really deliver excess performance for our clients. So I'm lucky enough to introduce Chris Dillon, who is one of those fabulous investment professionals. So Chris is in our global fixed income division. So the last time he talked to you guys was a couple of years ago. And while he started in global fixed income, they had lured him over to the multi-asset division. And then I think some of the pain of 2022 made them lure him back into global fixed income, because that just seemed to be a more challenging area and one for which people had a lot of questions. So I'm very excited to have Chris here. He's got 30 years of investment experience. He's been with T. Rowe Price since 2006. So he's got a lot of insight, not just about the firm, market in general, always an entertaining speaker. So with that, I'm going to turn it over to Chris to really kind of walk you through our Speaking of Markets presentation.
Katrina, thank you so much. And before I go any further, I'm looking for a thumbs up. Is my sound quality coming through okay? Thanks so much. And Luke, thank you for the kind words, Katrina as well. And for those tuning in this evening, I'm in the business of consuming as much financial information, market information as I can. That's half my time. The other half of my time is being out in markets and delivering a synthesized view of what T. Rowe Price thinks of the stock market. What do we think about global interest rates? And if you're not here this evening, that's not good for me and my occupation. So thank you all for joining this evening. And if any of you joined 2 years ago and you're joining again tonight, and a double thank you to you as well. Well, we are going to walk around the world. We're going to talk about, the Fed. We're going to talk about the U.S. economy, talk about interest rates, going to talk about what things that this means in terms of, stability of investments on a go-forward basis. And if we move over to slide 4 of this presentation, and I'm going to ask Katrina is kind enough to be driving slides here, and thank you. This is a great place to start. But in terms of diving into this conversation, and I've got about 20 minutes of prepared remarks. We do want to get to Q&A. Those that are going to be kind enough to stay in there. And any questions are on the table. And there's a lot to talk about this year. But I think this is a great starting point in terms of, just breaking down a really complex global economic environment, global investment environment. But I'm going to start with this conversation and this discussion and with something that's not even on the page. I want to discuss the U.S. economy and what's turning out to be a really resilient U.S. economic story and talk about some of the dynamics for that. It's off of that strength of the U.S. economy that will take us right into some perspective on inflation, a resilient labor market, which ties into that sticky inflation that's part of this discussion. And then we'll hit some of these other topics. But let's just break down the U.S. economy right now. And I just remember at Econ 101 from my time at the University of Delaware, and we can break the U.S. economy down into C plus I plus G plus net exports minus imports. Let's push the net exports minus imports. Let's shove that off to the side, although that is more additive with some things I'm about to say with a world that's become more protectionist. This is good for the U.S. This is good for U.S. industrials that are bringing manufacturing back to the U.S. But we're going to push that net exports minus imports to the side. And let's look at C plus I plus G. So C is obviously the consumer. That's 70% of the US economy. Well, the US consumer did an amazing thing during that ultra low investment environment that really crescendoed during the days of the pandemic. 10-year treasury yields going all the way down to 1%, 30-year fixed rate mortgages, 3% and around that range. US consumer did an amazing thing. 85% of US consumers that have owned a house went ahead and locked in their mortgages at a 3.5% mortgage rate, fixed rate, 30 years or better. That's in. So 85% of homeowners have an amazing mortgage interest rate. Federal Reserve raised interest rates remarkably during 2022. A painful year, as I'm sure we all remember, bad for bonds, bad for stocks. But that normally equates to bringing economic weakness to the US consumer. That just hasn't happened. And a big part of that story are those fixed rate mortgages. Another part of that story is, so that's the consumer, fixed rate mortgages, great story there. Something else supporting the consumer is a really buoyant, resilient, growing job market, vibrant. So one thing about the pandemic, it changed the world. If you're running a country and you didn't have enough rubber gloves or ventilators in your hospital system, an overstretched global supply chain, and you lived through the pandemic and you're leading a country, you really can't go back to that world. What's happened on the other side of the pandemic is nationalism has emerged. And this isn't just a US conversation. This is a conversation in Asia. This is also a conversation in Europe. But let's just talk about it from the US perspective. So bringing manufacturing back, overstretched supply chains, all this onshoring, friendshoring, nearshoring, it's brought manufacturing back to the US, and it's supported by industrial policy in the US as well. I'm sure many of us remember the Biden administration, Build Back Better, the big infrastructure spend that was going to happen in the US, which never happened from a headline perspective, but very quietly in Washington, D.C., it actually did happen just in a more condensed framework. So I'm sure you've heard about the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. Those are all subcomponents of Build Back Better that actually equate to industrial policy, incentivizing corporate America to bring manufacturing back. So remember, we're talking about the economy here, C plus I plus G. We're still talking about the consumer, but this onshoring, nearshoring, friendshoring has brought support to the labor market, that it really hasn't had since the late summer of 1981, when Ronald Reagan fired 12,000 air traffic controllers to bring wage spiraling that was driving inflation at the time. That the labor movement in the United States really hasn't been the same since, and American labor hasn't had more muscle than today. So let's come back to, again, C plus I plus G. So the consumer, fixed rate mortgages, and now a really good job market, and wages are growing at about 5%. This is really healthy for the consumer. So let's move off of the consumer, and the consumer gets at least a B plus off of things that I just said. Let's move over to I. I is investment. So I'm sure you've been reading the headlines in that we have this magnificent 7 set of stocks that are investing mightily in artificial intelligence, generative AI. Now, look, I'm not the tech guy, so I'm hoping we don't get really detailed questions on generative AI. I can talk about some things, such as my wife is a bodybuilder who has a coach that gives her a meal plan. I told her about Chat GPT, and she plugged in, give me a meal plan, and gave some specs on herself. And in a matter of a minute and a half, she had a meal plan that was better than the coach that she had hired was giving her. And she fired her coach 3 weeks later, just in terms of an example of generative AI. Anyway, let's get back to the point. The point is, you have these magnificent 7 tech companies and see the potential of generative AI, and they are spending a whole lot of money on semiconductors to just spur this advancement of technology in terms of generative AI. So again, US economy, C, we just covered the consumer, good shape. Now I is normally when we're late in the cycle, Federal Reserve aggressively raised interest rates in 2022. That normally slows down the economy, but you have this world-changing event. One is the pandemic happened, manufacturing coming back to the US, that's happening. And now you have artificial intelligence driving a big CapEx spend. So I, that's normally weak at this stage of the cycle, is actually, let's give it a B at this stage of the cycle, which is sort of unheard of. And then finally back to G, and that sort of ties into that industrial policy that I talked about, C plus I plus G. That's fiscal policy in the US, which right now is 40% of the US economy. You add all that up, and the most anticipated recession in recent financial history was supposed to happen last year. It never happened. And then people were thinking it would happen this year. It's not going to happen this year. There are questions about 2025, but right now, U.S. economy is in really good shape. So I wanted to start with the economy, and now that brings us to this page where inflation is sticky. And I talked about strength of the labor market. If we're going to have the Fed and they have a target for inflation of around 2% in something called core PCE, you can't have wages growing at north of 5%, and that's exactly where they are right now. So for right now, technology is going to catch up to this story, but inflation is sticky. There's a whole lot of money being spent in terms of generative AI. And what does this mean in terms of the Federal Reserve? Federal Reserve, much anticipation that the Fed was going to be cutting interest rates in March of this year, maybe June of this year. And let me just back up for a second. Why would the Fed be cutting interest rates when the economy is as strong as what I just described? So let me just give you the argument and the perspective of our economist at T. Rowe Price. So one, let's think of the job of the Federal Reserve. The job of the Federal Reserve is to provide price stability and full employment. So a level of full employment that's consistent with price stability. Right now, the unemployment rate is 3.7%. Let's call that full employment. And right now, headline inflation still around the 3% range. Fed's target is 2%. So it's a bit high. But the Fed's goal is to actually have that down to 2%. From a real-time perspective, late last year, our economist was doing real-time math on what was happening with that core PCE. It was on pace of around 2% because of economic weakness in China. So if you're at 2% from a very real-time perspective, it just hasn't caught up in the data that we see in the newspaper. You have full employment and you have 2% inflation. And the Fed also tells us that their policy rate when everything is just right, and I just described it as just right, well, their policy rate when everything is just right is about 2.5%, when right now the top of Fed funds is 5.5%. So there's this argument that you won't keep this strength of the U.S. economy because monetary policy is too tight. So a resilient labor market, inflation sticky. What does all this mean for the Fed? I think many were thinking 6 interest rates cuts from the Fed beginning in March, not going to happen. Been pushed back to May. Looks like that's not going to happen. Pushed back to June. So here's the thought, and this is, again, overly restrictive monetary policy relative to inflation that's still sticky, but gotten better. So we're expecting 3 interest rate cuts from the Fed, and that may be it for a while. Not as much as the market was pricing, but from our perspective, the economy can work with this in a relatively higher interest rate environment than the environment that we've been in. Corporate America can work with it as well, and it's actually good for the banking system. So it's going to be higher interest rates. And I'll quickly just touch on the inverted yield curve. Right now, a 2-year Treasury yield is yielding 4.64%. Right now, a 10-year Treasury yield is yielding 4.26%. There is a time value to money. A 2-year Treasury yield should not be yielding more than a 10-year Treasury yield. Well, we had a government shutdown last year, and a whole bunch of T-bills got issued to keep the lights on in Washington, D.C. That glut of issuance at the front end of the curve has actually pushed the yield at the front end higher than where the 10-year is. As the Fed cuts interest rates, an inverted yield curve normally signals recession. From our perspective, and always dangerous to say this time is different. Inverted yield curve is not signaling a recession from T. Rowe Price's perspective. Finally, on the lower right-hand side, recession risks remain. So this was our presentation at our Global Market Outlook at the end of last year. Conversations changed a little bit. We are not expecting any type of recession this year. U.S. economy is rocking and rolling, so to speak. Can there be some weakness next year? There are some clouds looming on the horizon. That's certainly a conversation for maybe mid-2025, late 2025, but not right now. So, Katrina, if we next move to slide 6, please. And all eyes on central banks, that one. So I just talked about the importance of the U.S. Also, just looking at other global central banks, it's just more of an interest. The United States is in a great position economically from a developed world perspective. And I'll just give a very quick example before we move off of this slide. But the United States, with the U.S. dollar, still the world's reserve currency, is allowing the strength of the U.S. economy to not be tripped up by aggressive Fed policy that came last year. And I'm just going to hit on the UK, because right now the UK, as a former island empire, but still an island, doesn't have a reserve currency and is being impacted by developments that are happening in the Red Sea, where there's upset disruption in the Mideast. And the Red Sea is actually impacting the UK, and they have inflation that's not trending the right way. That puts their central bank in a bit in a bind. The only reason I bring this up is the US is in a really good position here from a global central bank perspective. All eyes on central banks, and I just gave perspective on the Fed. 2 or 3 cuts this year, that's going to be it. Higher interest rates, but US in good position. If we next move to slide 7, please. And slide 7.
That is slide 7.
Which
Don't need to go for it.
be tech mega caps or
Oh, that's 8.
No, I'm
There we
sorry.
go. Oh
Sorry.
no, previous.
Sorry,
Okay.
Katrina. Please, if we could just let's just keep going. And one more. My fault. Thank you, Katrina.
Wait. Where
And
was that? There, right?
No, let's keep going. I'm looking for
Okay.
the AI and tech. Let's keep going.
Ah.
And talked about this a little bit at the outset of this conversation, but right now there are 7 big stocks in the US that are really driving unbelievable performance here in the US. And one message we're going to leave at the end of this presentation is if you were put in a time machine and you went back to March 23rd, 2020, and the pandemic was erupting, and soon to what was to follow 12 months later was Russia invading Ukraine. And then you were going to get developments in the Mideast. All of those things were going to happen. And if I told you that the S&P 500 has been up after dropping 35% during those first 3 weeks of March 2020, that if the S&P 500 is up 141% since, I think if I told you that, and I told you that was going to happen back in March 23rd, 2020, you would have thought I was out of my mind. But that is what's happened. A lot of things have happened, but some amazing developments have happened from the technology perspective. So this brings back questions around 1999, the tech wreck, .com bust, many of those things. This isn't 1999. This is the magnificent 7 companies with powerful free cash flow that are spending mightily on generative AI to become even more formidable companies. There are going to be second derivative effects to this. So we're at all-time highs on the S&P 500, but there's more room to go, and there are second derivatives of this that's to come. But for right now, still technology in the U.S., robust here. We're just making sure we are diversified here at T. Rowe Price, and that's also why you're working with Lifetime Financial. Because Trina, if we could move to slide number. If we could just scroll through, Katrina, slides. Let's stay here. So opportunities from the T. Rowe Price multi-asset perspective, from T. Rowe Price Global Fixed Income, T. Rowe Price Equity. Artificial intelligence and technology. We've already talked about this. But the applications of this isn't just a technology phenomenon. This impacts healthcare. This impacts biotech. In terms of like all of the quantitative work that goes into discovering amazing drugs, it requires an enormous amount of math. And it used to be machine-oriented computing power that was driving all that. Generative AI steps in here and is going to accelerate the speed of biotech. This also accelerates the efficiency of medical device companies. So healthcare innovation and AI and technology, they go together. Energy and commodities, US, this is not, if anybody brings up the 1970s, this isn't the 1970s in terms of inflation can't come down. The US got disrupted from a oil shock perspective in the 1970s. Inflation erupted, never came back down. US is one of the world's leaders in terms of energy production and one of the top producers in the world right now. It is peak US production right now. But I bring this up in terms of we are constructive on energy companies. The space is consolidating. There is going to be big demand for U.S. energy with a Europe that is not, which is not being provided by Russia to Europe anymore. We're constructive on the energy space, and it's also a consolidation story. Emerging market equities is a tricky one. It is tough in China. They have a housing bust on steroids relative to things that happened in the United States, 2006, 2008. And that holds back some development, major development in China. So China was down about 15% last year from an emerging market perspective. But remember that conversation I was talking about, nationalization, onshoring, nearshoring, friendshoring, and I said supply chains getting reconfigured. So last year, India was up about 35%. Mexico up north of 30%. So there is really powerful opportunities in this kind of world dynamic that's changing, becoming more protectionist. And the other story that I would add here, where T. Rowe Price multi-asset really constructive, is a story where it's tough for China, and it's tough for China with this reconfigured nationalization that's going on. And a lot of other development is happening in China with industrial policy, sort of like the US going protectionist, but Japan ties into that story. There's also a corporate reform story. Japanese equities had a powerful year last year and continue to do so year to date. So Katrina, if we could please move forward. And move forward. And let's keep going. And again. And again. And again. My apologies. And again. Again. That conversation, part of this discussion that I brought up March 23rd, 2020, when the S&P 500 had dropped 35% in a matter of weeks at the eruption of the pandemic. But since that time, the market's up 141%. This is just long-term studies that T. Rowe Price multi-asset has done in terms of looking at investor behavior at the worst possible moments when we all want to take our cash and run and put it under the mattress is actually the worst time to actually take your money and run. I think this is the time when it's the importance of working with Lifetime Financial. These are the professionals that save us from ourselves, but save us from, stuffing the money under the mattress and meeting some amazing or missing on some amazing upside when unexpected things happen that can absolutely drive performance off of really low valuations. So staying the course, it matters. If we go to the next slide, please. And a future regret is a better guide. I think one thing that I mentioned about generative AI, tying into healthcare, tying into biotech, tying into better drugs, medical device companies, you name it, this whole new frontier. The good news is we're all going to live longer. And if we're all going to live longer, the game is to stay ahead of inflation. And look, the Fed's going to get it back to 2%, but we are going to be in a bit of a higher inflation world in a less globalized world. Staying invested, staying the course, it matters. Staying and working with a great professional that saves us from ourselves, like Lifetime Financial. That's the strategic game plan. If we please move forward. So Sebastian Page, who I had the pleasure of working with for 7 years in multi-asset, he keeps it simple. Stay invested, stay diversified, and let's take advantage of opportunities that show up in markets. That's where the partnership between T. Rowe Price and Lifetime Financial comes in, and they in turn can be a great partner to you, the client. If we please move forward. And review your financial plan with your financial professional. There are a lot of things going on. There's an election coming this year. There's a Fed in play. There's generative AI and technology and second derivatives off of that. Many things to talk about, but I'm going to bring this conversation in for a landing here. I want to hear questions that you have with so many things, and it's tough to walk around the world in 20 minutes. I think I just did it. And I'm going to pause there and let's see if we are able to get some questions to continue this conversation.
Great, Chris. Well, thank you so much for those prepared remarks, walking through the T. Rowe Speaking of Markets presentation. And I know you have a challenging job because the world data changes so quickly, and we have a presentation timestamped as of 2023, and how quickly do things turn? Even the expectations you shared about cuts in terms of interest rates versus what was forecasted before. I think that's one of the most important things we'll be watching as 2024 plays out. So Chris, Katrina, thank you so much for delivering the Speaking of Markets presentation. We'll be sure to funnel any additional questions to you, but for those who are joining us live, we'll get to the Q&A session in a moment, but sincerely wanted to thank you for the ongoing partnership and for all of the great investor education that you've provided and just keeping us appraised on what's happening. Again, with just the data flow being so fast and rapid in this modern era. So thank you so much to the two of you. Really do appreciate it.